Welcome to this explainer. Today we're doing something really cool. We're distilling J.L. Collins's core concepts from the simple path to wealth, but we're looking at them through the eyes of 20 legendary financial thinkers. We're going to show you how mastering your money, well, it's really about mastering your psychology. It's not just about crunching numbers. It's about avoiding debt, saving aggressively, and keeping your investments brilliantly simple. Let's dive in.
Here is our blueprint for today. First, escaping the debt trap. Second, saving as a superpower. Third, the index fund advantage. Fourth, surviving market noise. Fifth, simple asset allocation. And finally, achieving true freedom.
All right, part one, escaping the debt trap. We're looking at the psychological toll of borrowing.
Think about it. Debt is usually the very first financial reality millions of us wake up to every single morning. To truly understand wealth, we have to honestly ask ourselves, when does debt cross the line? At what point do our monthly payments start quietly removing our options and dictating our life choices? Because, if you can't leave a miserable job just because your bills are too high, well, debt has literally become a form of bondage. Now, the contrast between these two perspectives is fascinating. On one hand, you have Robert Kiyosaki, who sees strategic leverage as a useful tool to buy productive assets and create future cash flow. But on the flip side, Dave Ramsey strongly warns that our culturally normalized debt strictly restricts our personal freedom. But here's the thing, regardless of which camp you lean toward, the top financial minds completely agree on one thing. Borrowing just to consume? Yeah, that's a really dangerous trap.
And we have to recognize that the reasons people go into debt are incredibly complex. Suze Orman points out that debt often masks deep emotional pain or insecurity. Basically, people spending just to soothe themselves. But then you have Elizabeth Warren's reality check, noting that for a lot of ordinary families, borrowing is simply a tool for systemic survival during unexpected medical or economic emergencies. No matter how you got there, escaping it is universally the first step to freedom.
Moving right along to part two, saving as a superpower and reclaiming your life energy.
Saving isn't just a basic math problem where you try to earn more and spend less. It's so much deeper than that. As Vicki Robin philosophizes, when you start viewing money as your traded life energy, because you literally traded your precious limited time on Earth to earn those dollars, your entire perspective shifts. You actually stop asking, can I afford this new car? And you start asking, is this new car actually worth a year of my life?
To actually build this superpower, you kind of have to juggle a few different mindsets. You need to reject visible status, like Morgan Housel suggests, because true wealth is usually the money you don't see. But at the same time, it's wise to follow Ramit Sethi's advice to avoid joyless self-denial. Spend generously on what you truly love, while cutting relentlessly on what you don't. Ultimately, as J.L. Collins points out, having a high savings rate creates a buffer, a margin, and that margin creates absolute resilience in your life.
Okay, part three, the index fund advantage, or as I like to call it, owning capitalism.
This crucial point is captured perfectly by the legendary John C. Bogle. His philosophy, instead of frantically searching for the perfect stock, trying to predict the future, or paying massive fees to a financial guru, just buy the broad market index. By doing this, you completely remove the impossible burden of prediction. You just sit back and let the combined power of human ingenuity and capitalism work for you over the decades.
Look, we all know it is incredibly tempting to chase exciting stories or complex Wall Street products just to feel smart. Our ego absolutely loves complexity, right? It wants investing to feel like this high-stakes, adrenaline-fueled game. But true wealth actually comes from the quiet humility of indexing. It's about embracing low fees, getting broad diversification, and accepting that boring is often incredibly beautiful when you let it compound over time. Charles D. Ellis famously calls investing a loser's game. And to win it, you simply need to avoid high fees, stop overtrading, ignore your emotional impulses, and firmly reject overconfidence. To put that into perspective, a tiny 1% fee can literally eat up nearly a third of your potential wealth over a few decades. The winner in investing isn't usually the person making brilliant, flashy moves. It's the person who just consistently avoids these costly, unforced errors.
Which brings us to part four, surviving market noise, the daily emotional temptation.
Because let's be real, a simple plan is utterly useless if you just panic and abandon it. Benjamin Graham gave us a truly timeless concept for this. He said, do not confuse the short-term emotional voting machine of daily market prices with the long-term weighing machine of actual business reality. Those daily prices, that's just the market's mood swings. Long-term value is what actually reflects human productivity and innovation.
Warren Buffett has this wonderful analogy that brings it all together. He compares owning stocks to owning a productive farm. If you own a farm, you certainly wouldn't sell it in a panic just because some neighbor leaned over the fence and yelled a lower price at you today, right? You look at what the farm actually produces. In the exact same way, you shouldn't sell your index funds in a panic just because the daily news cycle is shouting a scary lower price at you.
So, thinkers like Charlie Munger and J.L. Collins advise us to build some vital daily habits to protect ourselves. Expect crashes before they arrive so you're not caught off guard. Create some distance between yourself and the manic news cycle. Automate your investments so your own emotions can't derail your future. And most importantly, write down an investment policy for yourself during the calm times to act as a solid guardrail when fear inevitably strikes.
All right, on to part 5, simple asset allocation, balancing growth and safety.
Think of the physical structure of your investments like this. Stocks act as the powerful engine you absolutely need for long-term wealth building. But, as William Bernstein reminds us, bonds serve as the essential ballast. They are the stabilizing force that keeps your portfolio, and honestly your stomach, steady during terrifying market drops. Finding the right balance just depends on your true emotional reality.
Experts like Rick Ferri and David Swenson make a great point here. Keeping your asset allocation simple isn't just cheaper, it exposes your true risk tolerance rather than your fantasy courage when the market is up. It prevents you from mindlessly collecting overlapping, expensive funds, and it demonstrates deep intellectual restraint. Complexity should have to earn its place in your portfolio, and you know what? Most of the time, it simply doesn't.
And finally, part 6. The whole reason we do this. Financial independence means freedom and redesigning your life.
Because if there's one massive consensus among all these incredible thinkers we've explored, it's this. The numbers sitting in your bank account are basically meaningless unless they grant you the freedom to reclaim authorship of your own life. Financial independence isn't about just sitting around doing nothing forever. It is about having the ultimate freedom to choose what you do next, entirely without fear.
But there is a pretty profound warning here from Tim Ferriss and Naval Ravikant. Outer freedom, like finally quitting that stressful job, is completely empty if your mind is still trapped by status, envy, and comparing yourself to others. Furthermore, if you escape the office but you haven't built a meaningful life outside of your work, you might just optimize your way into a very boring, purposeless retirement, and nobody wants that.
So, to actually redesign your life, you need to start running small experiments, like mini retirements, right now. Don't wait. Reconnect your money with actual meaning. Find your purpose totally outside of your corporate titles, whether that's volunteering, creating art, or just spending unhurried time with your family. And above all, maintain the fundamental simplicity that bought you your freedom in the first place.
Which leaves us with one incredibly profound question to wrap up this explainer. How much of your future are you willing to own? By avoiding the debt trap, saving aggressively, indexing simply, and tuning out the noise, you aren't just building wealth, you're reclaiming your time, your peace, and your entire life. Thanks so much for joining me on this deep dive. Now go out there, keep it simple, and take ownership of your future.